Hello everyone, George Dos Santos here with a look at the market for the week ending May 1st, 2020. And I hope everyone is safe and stay away from this crazy virus. In any case, let's bring up the disclaimer, take a look at it, realize that I'm not an investment advisor, not trying to give any particular person investment advice. And so if you seek that out, do so from someone who is so qualified. We'll begin as usual with a look at the S&P, a weekly chart of the S&P 500. So let's bring that up. So let's start by looking at the moving averages. You can see that the thing that I was concerned about last week was that this 4 exponential moving average was still below the 9 exponential moving average. So technically, as I mentioned last weekend, from the point of view of moving averages, as far as they're concerned, we did not really have a change in the trend last week. We did have the parabolic below the most recent bars, and the parabolic is still there below this last week's bar. However, let's take a look at something else. Last week I mentioned that there's a lot of overhead resistance. There's a 618 retracement, Fibonacci retracement, this line here. There is the 30 weighted moving average. I pointed out that there's the 50-day moving average, or in this case, it would be the 50-week or 50 period, if you wish. And so all of this resistance was giving me some pause, and in fact, that's why I said I'm mostly in cash, which I am still mostly in cash. So what do we get? We got a shooting star, what I sometimes call, or some people call, the finger. You're getting the finger here. And what Dan Granza says about this is, look, the market attempted to break above here, this level here, and the market rejected that price, this price up here. The market rejected it and closed all the way down here. So this is what we had insofar as the price bars are concerned, moving averages, parabolic, etc. Now I remove the MACD histogram so that we can see more clearly what's going on here, but I'll put it back on in a second. You can see that Williams percentile is still above the minus 50 magenta line. So we still have this struggle between bears and bulls. I'll have a lot more to say about that later. And last week I pointed out that some of the rate of change indicator, Jerry Appel's indicator, excuse me, was still not above that 4% line. So it still wasn't indicating an uptrend. So this is where we stand. On the weekly chart, we're getting a lot of resistance here. And so let's turn to the daily chart. So here's a daily chart of the S&P 500. You can see that we had that death cross here where the 50 crossed below the 200. This white line is the 200-day moving average, and this red line is the 50-day moving average. So we had what is called a death cross, where these two averages cross. And then we went further down. You can see we made this low of 2109 here. Let me move this across. You can see we made the low of 2109 right here. This was 2109. And then we rallied up from here. Now we rallied back up to find that resistance level between the 50 and the 618 Fibonacci retracement levels. Last week I was moving the cursor up and side to side here, saying there's a lot of resistance here. You know, it just keeps hovering around that 50% retracement level. Well, we moved up a bit last week, and then we had that finger, as you saw, the shooting star, and we came back down on Thursday and Friday. Now, let's look at moving averages. The 4 is still above the 9, but that is likely to change. You know, it could go either way here. We now have parabolic above the most recent bar. So the parabolic is now telling us on the daily chart that we have switched now from this short uptrend here to a downtrend. And you can see the resistance of that 200-day moving average on the daily chart more clearly. Now, if you look at the other indicators, we still have Williams percent R above the -50 or magenta line here. And we still have some of the rate of change above the 4% line. But my sentiment has changed significantly since last week. I was having my doubts last week about buying the market. I even said, look, if you put a gun to my head and said I have to choose to buy or sell, that I would likely buy. I'll have to say buy, but not betting the farm anyway, because I was so concerned about all this resistance. Still holding a lot of cash. So this downtrend here is likely to continue, and I'll show you why. I'm going to bring up some other charts and show you why. Now, I read an article by Colucci back in 2016. He actually wrote it in 2012. And what he does in this article is try to show that there's an indicator which we look at it almost every week, the percentage of stocks of the S&P 100 above their 200-day moving average, and how that relates to the S&P 500 itself. So he uses two key levels, 65%, 50%. And if you want to see how that at least correlates with the movement of the market, let's go down to the S&P chart. You can see that this is in 2011. Okay, this is what happened in 2011. So you can see here that they had a death cross here, the 50 cross below the 200-day moving average, and that was in August. And then the market, of course, the market was on its way down when that happened, similar to what we had this year. And the market made this low, it rallied a bit, came back, made a low, rallied again. But the thing I find is interesting is that when it got back up to the 200-day moving average, close to it at least, it came back down again. So let's take a look at the current chart of the S&P 500 and see what we find there. I don't know about you, but this thing looks almost like a mirror image of what we just saw occurred in 2011. The market started coming down. You'll notice that it occurred before the death cross back in 2011 as well. By the way, I'm sending you the link to that whole article so you can read it yourself. But you can see the market started coming down. You got the death cross here. You got the bottom here. You got a rally, come back a little bit, not as much as in 2011. And now we're back up to the 200-day moving average. Now, so the question is this mirror image going to continue to be very, very similar to 2011 or not? If it is, then we can expect further declines in this market. Now, you know, some time ago, about 2 weeks ago, approximately 2 weeks ago, I sent you an email, those of you who get emails from me. And the gist of the email was that I'm not an economist, but what I do know is that stock prices are driven by earnings. How does a company derive their earnings? They derive their earnings by selling product or service or services and earning money on that revenue. Well, given the conditions of this whole market and the virus, etc., people are not working. We have what, 20% unemployment or more. People are out of work, they have no money, they're depending on the government to send them a check. So if that's the case, I mean, how can I reasonably expect this market to go much higher in the immediate future? Maybe in 2 years, maybe in a year and a half. Who knows? Like Fats Waller says, one never knows, do one? But I just can't put a whole lot of money into this market at this time because I'm seeing too many indications here. The resistance, the mirror, it's almost a mirror image of the not a mirror image, but a clone of the 2011 chart that we just saw. And we're not back up to those levels where we could say, yes, this market should go higher. So that's my take. I mean, again, I'm just a poor little guy trying to make some money on the side here. Take it for what it's worth. And here's a daily chart of the S&P again, and it's the cloud. You can see the Ishimoku cloud, and we're just above the cloud on the S&P. But the key thing I want to show you here is I drew a channel, these two parallel lines here, and you can see that price of the S&P remained within this channel for some time now, since we've had this breakout, since we broke above this level here. So what we have here is we are sitting right at the bottom line of this channel. So I would think that we are at a juncture here where we are either going to bounce off of this bottom line of this channel and go higher and perhaps stay within that channel and continue to trend up, which I don't think is going to happen, or we're going to break the bottom line of this channel and continue to come down and make another low, maybe not as low as the March 23rd low, but make a low somewhere in here, and then we go higher from here. But again, as I just pointed out, I am not too enthusiastic about the prospects for this market within the next 6 months to a year anyway. So that's just my take. Here's that chart we've looked at many times before. Well, this is actually a weekly chart of the spread between the new highs and new lows, 5-day average. I spoke to Alex. Actually, I exchanged emails with him, and I mentioned this chart to him, and he says, yes, George, be careful, because back in 2018, we came down here, but we just broke below minus 8,000. In this case, we were all the way down here. We broke all the way down here to minus 14. And he seems to indicate that in this case, he doesn't think that we're going to continue to have this kind of a rally up here like we had here, you see. So he thinks that we're going to come back down also. Here's the current chart of the percentage of stocks of the S&P 100 above their 200-day moving average, and you can see it's sitting at 32%. And according to the author of that article, once we have to get back up above 65%. This is about where it was, and you can see that once we were above that, market was in an uptrend. But here we've broken down, and we're not back up there. We are not even back up between the 50 and the 65% level, which is where you could do some trading according to Carlucci, but we're not there yet. So take it for what it's worth. We just have a couple of minutes left, but if we take a look at Shaken Analytics chart of SPY, which, as you know, is the ETF of the S&P 500, you can see what happened here. The market rallied, and it just hit that their long-term moving average, which is somewhat like a 200-day, and it bounced off right off of it. So you're getting some confirmation here. This is that resistance once again. Now, these are the ETFs that are outperforming. Well, they're the best performing ones. The healthcare, XLV, QQQ came back quite a bit. I haven't discussed that, but I should. XLC, XLK, these are the ones that are performing best of the ETFs. Okay, so we'll take a quick look at the stocks for the lockdown. Some of them, many of them are overbought, but I used to own some. For example, you can take a look at Box. I think Box is oversold. Let's see, Akamai, I think that one is oversold. There is Teladoc, I'm not sure where that is. It's coming back down to oversold. Zoom, I traded back and forth, a number of times. It's been very volatile, so I've been buying and selling it. And what else we have? CrowdStrike, I still like it, but it's coming into oversold territory. I'll wait until it gets there if I'm going to buy anything in this market. And there's one that's Peloton. It's now very oversold. And Stock Charts did an article on it. Well, folks, that's it. I got to run. Have a good weekend. Bye-bye.